Thank you, Innocenzo Cipoletta. Now it's we are obliged. Now it's the job of this podium to do something entertaining for the remaining hour. So please don't expect us now to have another row of 10-minute speeches. But at the beginning anyway, we should hear the presentation of Mr. John Llewellyn, the co-founder and partner of Llewellyn Consulting, and an analyst of the possibilities and the state of the art of the Capital Markets Union. Please, Mr. Llewellyn.
Thank you indeed, Mr. Chairman. When Professor Gorona asked me to speak to you tonight, he asked me to do two things basically. He said, first of all, if you will, pull together what you think it's likely people will have said. And secondly, raise the question, which I'm going to do, as to whether we're going fast enough or whether, as Mr. Rossi possibly hinted, I wasn't quite sure how hard he was pushing the point, felt that something more like a big bang would have been in order. So let me do those two things. The first point I think to note is the EU has been moving towards a notional capital markets union for decades. Don't let's make the mistake of thinking that all of this has just come out of the air. Major European legislative initiatives were launched in the 70s, the 80s, the 90s. The early focus was in banking and insurance. Initiatives concerning securities and investment management came later. The Single Market Programme, launched in 1985, and the Single Market Act of 1987 were important milestones. The Financial Services Action Plan, launched in 1999, was an attempt to give the single market in financial services another major push as the euro came into being. And that Financial Services Action Plan itself put forward a 5-year timetable for the achievement of 3 strategic objectives: establishing a single market in wholesale financial services, developing more open and secure retail financial services markets, and strengthening the rules on prudential supervision. And under the previous Commission, a whole host of initiatives were progressed. And in many ways, as I say, recent discussions on Capital Markets Union echo those of the past. I think you can identify 3 key objectives: progressing the job that was started many decades ago, fixing deficiencies laid bare by the crisis, which I think we're obsessed by at the moment, and adapting to meet future challenges, which I hope to God we get to. Now, it's been said, and it's worth just recapping on the figures, that Europe's got much untapped capital market potential, and of course we always compare it with the US, because that's the only one that's got any chance of being comparable. But in Europe over the past 5 years, long-term pools of capital have generally been much smaller than in the US, particularly pension assets. They've only run at about 30% of the US total. The corporate bond market has been around 40% the size of the US, with a larger shortfall in the high-yield market. Equity markets have generally been around half the size of the US, and venture capital markets around 1/8. Now, Mr. Rossi, when he spoke, observed that growth tends to be somewhat faster in countries with capital markets and less dependence on banks. I think that's probably so. I think it's also worth saying in that breath that there's also less risk. Very important to remember Mr. Greenspan's spare tire, as he called it, when he observed that in 1998, in the Asian crisis, when their banks folded, there was no other channel for intermediating between savers and borrowers. And by God, those countries went through hell. They really did. And you compare that with when the US corporate bond market froze in 2000, 2001, there it didn't have anything like as disastrous effect because the intermediation switched to being done through the banks. The banks charged for it, they made a fortune, but at least the channel remained open and you didn't get the plunge in aggregate demand. And Mark Garvin raised this point as well. So I think there's both points are worth remembering, not only the growth point, but the insurance point. The aggregate picture, though, masks regional and cross-country variation of some scale. Europe's capital markets are most developed in the region's northern economies outside the euro area, the UK in particular, obviously, as we've heard many times, but also Switzerland, Denmark, Sweden, Iceland, and Norway. Southern Europe has markedly less developed capital markets, and Central and Eastern Europe, very small markets indeed. So don't let us make the mistake of talking about Europe at the moment as if it's a homogeneous entity, because it simply is not. CMU now seems set on delivering in a few key areas. And I think it's worthwhile to start with the agenda as it was laid out by Nicolas Véran, who frankly I regard as having driven this agenda intellectually speaking. And last year in 2014 he identified very early on 6 areas where he thought there was a case for progress. Regulation of securities and specific forms of intermediation, prudential regulation of financial institutions, both banks and non-banks, accounting, auditing, and transparency more generally, supervisory frameworks for financial infrastructure firms, corporate insolvency and restructuring frameworks, and tax regimes. So that's what he came out with. If we're really going to do a capital markets union, those are the areas which we could really think about. Now, Lord Hill has latterly placed 3 themes at the heart of the project. Now, these are themes, so it's quite difficult to make the transposition, but I'll help you get there in a second. He put increasing funding options for business, about which I've just spoken, creating more opportunities for investors, and encouraging cross-border investment. And he's proposed a range of policies under his themes 1 and 2. And they appear to fall largely under 1, actually, and a bit under 2 of Nicolas Véran's list. Looking at that in a bit more detail, I think it's only fair to say that the wider agenda appears to have been scaled back somewhat. If you take Nicolas Véran's Area 1, regulation of securities and specific forms of intermediation, or Lord Hill's theme 1, increasing funding options for business, this strengthens venture capital and other non-traditional financial support. For the private placement market, this is the review of the prospective directive, and there's the development of simple and transparent and standardized securitization products. So that's good. And then Nicolas Véran's second area, prudential regulation of financial institutions, under theme 2, creating opportunities for investment, as Lord Hill has put it, create opportunities for retail and institutional investors, encourage more investment in infrastructure. We've heard a lot about that today. Update calibrations for Solvency II and the capital requirements regulation. So far so good. For the future, well, if you take Nicolas Véran's areas 3 to 6, there's a lot still for the future. There's accounting, auditing and transparency, supervisory frameworks for financial infrastructure firms, corporate insolvency and restructuring frameworks, and taxation regimes. Now, I want to be balanced in this. If you ask Lord Hill what he thinks about all of that, I've put together this quote from him, and I think it shows you why he's positioned as he is. For example, on his theme 3, he says there are many long-standing and deep-rooted obstacles that stand in the way of cross-border investment. Mr. Rossi spoke in these terms. These range from obstacles which have their origins in national law, insolvency, collateral and securities law, through obstacles in terms of infrastructure, right through to tax barriers. And he says on some of these issues, particularly those linked with taxation, the feedback suggests we should be pragmatic. In other words, we shouldn't risk, and I think this is the key point in his eyes, we shouldn't risk making good progress in other areas by charging headlong into some of the most intractable ones. And I think that's the problematique, if you like. How should we, therefore, assess the current state of play? I've gone, there we are. The incremental nature of the current action plan contrasts, as I've said, with the more ambitious initial agenda. Véran suggested that the Commission's plan largely boils down to pruning existing rules and reversing some of the post-crisis regulatory overreach at the European Union level. Lord Hill, perhaps, would argue that the pragmatic approach is best with the focus on delivering some early wins and in some key areas for growth that would make a real difference. Now, of course, political economy constraints abound. Politics, it's been said, is the art of the possible, and if politics is the art of the possible, then of course policy is the art of the possible. But I certainly I'd invite you on reflection to ask yourselves some questions. Is it enough to try to develop some key markets such as securitization, private placements and so on? Or should the focus be on delivering a bigger, broader Big Bang? Can most of what is needed to be done to ultimately be done within the current institutional setup? That's a question, you know. And is the UK renegotiation an opportunity as well as a threat? And I think that to some extent will be a matter for what the players make up to be. Chairman, I'd like to close with this point that policy is the art of the possible, or politics is the art of the possible, and so therefore is policy. Some years ago, the OECD, when I was working there, although I didn't do this work, wrote a very interesting paper indeed on the political economy of structural change, and we're talking about structural change. And they found that successful structural change, and they looked across at all of the countries which have done successful structural change, whether it be the UK or Denmark or much more fundamentally Australia or New Zealand, but there are many examples. And they found that you've got to get an awful lot of things in place in order to do really effective structural change. And I just took that paper for this last slide here and put it into the context. What might you arguably need at the European level if you were to really effect structural change on a grand scale? And what this study suggests is, first of all, you need the support of your main institutions. In this case, of course, the main European institutions. You need the support of heads of state. The heads of state personally have got to believe in structural change if you're really going to make it work. You need broad support across their cabinets as well. It's not just enough for the head of state to think it's a good idea. He needs, or she needs, the support of the cabinet. And you need an opposition that is either supportive or at least insufficiently strong to make a difference. If you've really got the opposition campaigning against you, it works out pretty hard. You need points of light, as they called it, across society. Business people, academics, journalists, who influence thought, who all think that this is a good idea and write about it and talk about it. You need a simplicity of purpose. It has to be a very easily understood agenda for the populace. You need a positive message. In this case, it would be the growth and the stability. I would say increasingly the growth case for Capital Markets Union. You need the ability to assess progress. You have to be able to say to people, we are making progress, what you're going through is worth it. If you can't point to progress being made, then it will die. You need initiatives, at least temporarily, to temper the costs of the inevitable losers paid for by the fortunate gainers. If the policy comes across as intrinsically unfair to a group, it usually founders. And you need sustained positive momentum. Academics often talk about the desirability of sequencing, but actually what you just have to do is keep going and stop people ganging up against you. So, message of that slide, ladies and gentlemen, is you need to get a lot of things right if you're going to do structural change on a big scale. So, to the extent that there's a case for a big bang. To the extent there's a case for saying we're going too slowly, then I think we would have to address those issues to make sure that they were all in place. Thank you very much.
Thank you, Mr. Llewellyn. Maybe we can have you at the very end to assess what we're going to do now. Now we'll try to have some debate that could also include you who are watching. I would suggest that if there is anything that you want to put onto the podium, even if it's disruptive, send a piece of paper that I possibly can read, and we can put your questions right into the discussion. And there are the kind ladies that will bring your suggestions to me. We are here with a table that represents different places in the maybe future capital union. That is Paris, London, Frankfurt, and Rome and Milan. So may I start maybe with Nicky Edwards, Director of Policy and Public Affairs in TheCityUK. That is the body that is looking after the view of London. If we try to organize our discussion at least in 2 rounds, try first say how do we get there and what can we gain, what can your town, your country gain out of the Capital Monetary Union. Maybe in the second round we can assess about what is the relation between a center, how centralized or decentralized can things be, and how great are our fears in this. So we want in the end, we want a system with a bit less banking and a bit more markets. And what can we gain there, and how do you get there? I can remember that there have been years when London was talking about the Big Bang, and it was not just a discussion for a room of experts, but people would discuss it on the streets. Was that something that was desirable? Was it something that gained something that you would sell us as an example? Or is there some caveat? Please.
Thank you. And actually the City UK, as the UK part of our name implies, isn't just the City of London, the Square Mile and Canary Wharf. It represents financial and professional services firms across the whole of the UK. And I think that's an important factor in considering the response to this question, because we think about people in every part of the UK and in every part of the economy which are served by financial and professional services. The city in which the Big Bang was detonated was one that had market practices that Queen Victoria would have recognised. And that's not where we are today. That's not the point from which we're starting. Although a Big Bang is attractive because of the energy and the excitement it generates, we have to bear in mind the experience of the previous European mandate, which spent 5 years putting in place the regulatory framework that was necessitated by the financial crisis. That really substantial burden of regulation that has been put in place now needs to be given a chance to be refined to work better. I don't think there's any appetite amongst policymakers and importantly amongst the public to see all that regulatory work, all the sense of recovering safety to be put to one side simply to create something new. And in fact, the approach of Frans Timmermans and the whole of the Commission in focusing on better regulation, in doing what's important to enable the creation of capital markets that work, is one that's very welcome in the city. And the prize that's at stake, as so many of our speakers have mentioned, is a creation of a single market for capital. One of the most important principles on which the European community, as it was founded, one of the things that will enable businesses of all sizes to access capital more cheaply, more quickly, and from a more diverse range of sources. So you ask, should we cherish a switch from banks to other sources? Of course, we welcome complementary sources of financing. Banks will continue to have a very significant role, but the ability of the economy to resist shocks in future will be greatly increased if that diversity of funding sources and the complementarity is achieved. Our research with SMEs, and in particular the mid-sized firms that have the potential to become big firms in the growth sectors of the European economy, shows that there is a great deal of cultural change rather than revolutionary change that needs to happen if those businesses are going to be open to accessing finance from more diverse sources. The chief financial officers of the companies that were interviewed reported that they are very limited in their thinking about any other source than bank finance. So in order to strengthen the economy, it's not the case, I think, that we need to have any sort of bonfire of regulations. We do need to understand that there's a whole ecosystem of information and support both for and about businesses that will help them to tap into much more diverse sources of finance.
If I may ask you a supplementary question on this, didn't the Big Bang in the UK create this atmosphere for change of mindset within the financial community? Because they were talking about it for quite a while, and so you couldn't say, just carry on as before.
Certainly a transformative moment. And I think when Mark Garvin challenged policymakers to be ambitious with Capital Markets Union, he possibly had in mind the need for another transformative moment. I would simply caution against suggesting that such moments have to be accompanied by all the noise and violence of a big bang.
So maybe here the position from Paris. So Mr. Edouard-François de Lencquesaing from the European Institute of Regulation. What is France and Paris able to gain from Capital Markets Union, and how would you like to get there?
A lot. We'll gain a lot. I come back on your conclusion, saying that policy is art of the possible, and I think that's what we are driving in France. And I have in mind this movie or book of Apollo 13, Mission Impossible. Our mission today, if we are a responsible actor of the financial industry, is to change the boundary of what is possible. And doing that will ease the politicians to do their job. First, we have to work on what appears to be impossible from Poland, Czechoslovakia, elsewhere, and to make it possible. And then we drive policies. Now that's why I want to give some slightly different approach on Capital Market Union. First, you have this question of why do we have that? Is it a choice or is it not a choice? First, for me, for France, it's very clear. We have no choice for two reasons. First, competition. It's not a question of inside a single market. It's a global competition. It's a global competition for the SMEs and corporate in Europe and for all our citizens, 500 million citizens, compete with other countries which have better cost of access to capital. We have to decrease cost of access of capital for all our constituents. And that is not a choice. It's a given. And second, we are in a corpus of regulation, a framework of regulation that, we want it or not, I don't know if the politicians had a clear vision of the consequence of that decision, but they make the decision that the banks have to lend less because of higher cost of capital. Then, because of that, we have in Poland, in Czechoslovakia, in all the countries, to adapt to that reality in a way or the other. Okay, that is why. Now the Commission, thinking about this context, gave us a new tool called Capital Market Union. New tool. It's still a tool. It's not yet a roadmap. It's not yet a roadmap. It's a tool. And in the 32 actions, a lot of actions are empty boxes, and we have to fill those boxes. What is interesting in this process, because there's two things about capital market, is the process, which is innovative, and the content. The process is interesting because for the first time, the Commission is coming back to the industry and say to the industry, can you help us to define the vision? The vision is not coming just from the politicians. The vision will come from the industry, bottom-up approach. And that is very interesting because the quality of the vision will depend on the input that collectively will be given to the Commission and to the Parliament. And that is all about the initiatives of a call of evidence. Will be a very tricky and complex process, but we are asking that for the last 5 years. We are asking how to measure cumulative effect of the different regulation. Now, since this morning, we try to highlight all the problems. In the capital market process, we are asked to address those issues and problems. That is the process, and the problem is that the industry is frustrated because for the first time, they are not just in a consultative situation to face a new regulation, a new directive. No, it's an open blank sheet. And that is very new, and we are frustrated. We should not be frustrated. We have to understand a positive role, and that's what we are trying to do in France. Now, in a few aspects of the content, it's clear that we have to start from the existing situation. The existing situation is that the European culture, especially for risk, is not American culture. It's different. Then it's clear that there is no clue that we try to copy the American model. Then it's clear that we'll still be in a kind of credit-driven model. All the problem on which we have to think and define aggregates or decisional process is to define how we'll go from the 2080 model, where we are, to another model. 50-50, 40-50, 40-80, or 40-60, and so on. We have to define more or less where we want to go. But the second question is that the 28 countries are not starting from the same position. We have more or less 4 countries that are quite mature in capital markets, meaning more than 20% of their economy is financed by capital market. UK, France is 38%. Luxembourg, Netherlands, and so on, so on. But 24 are probably less than 20, near 10%. And the question is that we have to address critical mass, because it's clear that we need a critical mass for those competitive reasons, access to capital. And this critical mass will not be built up just by the 4 countries. We need 28 countries. But if we accelerate the 4 countries and we leave the other countries around the road, we'll increase fragmentation between member states. And that is not acceptable because it will fragilize Europe. Then we need to think about a model that I call prox union, meaning proximity union, a union that integrates the fact that we are not starting on the same line. And to address this prox union, we need strong pan-European institution. And that's where another key word on this project is coherence. The other aspect of this roadmap is to address all the incoherence that we have. One of the incoherence is that we have to finalize banking union because we need strong banks. We need strong banks, and starting at the global level with FSB, the FSB is issuing new regulation that for the global SCFs If they deal cross-border, meaning a French bank dealing with Germany or dealing with Italy, it means that their risk profile will increase, and then the sanction of increasing capital will arrive. Then it's against the objective of having pan-European bank. That's a problem. Now, we have other incoherences. For instance, segregation of banks. We want capital market union. We know that already we face issues around liquidity, market liquidity, and bond liquidity. And we want to segregate banks, meaning market making being a problem. Then if we segregate, it means that we'll diminish the size of what will be segregated. Diminishing the size, it will be less competitive, less efficient. Then we have a lot of, and I will probably stop just right now, we have a lot of very important incoherence we have to address. One last incoherence, which is very important, is that all set of regulations need reporting. Reporting for regulatory reason, reporting and increase access to information. The point is that reporting means IT, means technology, means overall architecture. Today we are all reporting a lot of data to regulators. It's a huge garbage processing. There is no funding, no initiative, no strategy at the regulatory level to identify what would be the IT strategy. Then if you have very intelligent politicians and tax and regulation, but no tools, we go to the wall. And we are at this stage today. On the information side, we spoke about SMEs and so on, same thing. There is no collective approach to install a process to consolidate financial statement for corporate all over Europe. There is a very interesting initiative in Holland. They call that standard board reporting, which is a public-private process, very interesting. We are working today in France to try to adapt this process in France. There is a lot of opposition, but we'll try to do that, and that should be done also at the European level. 2 examples.
Thank you. Thank you. So on my other side, we find 2 countries that are very much banking based. And if I may come to the Director General of ANIA, the Association of Italian Insurance Companies, may I ask you, so in Italy there has always been the question about how can you bring more companies to the capital market, and we have a long time of presentations and articles that say there are 500 companies that can be taken into the public. Then we hear from President Cipolletta that also the venture capital side is rather small, and then we have insurances that are big enough to also invest directly without banks. And then, thank you for the question that was sent to me. There's a question, does technological innovation give the power of reducing all these intermediaries? I mean, even in Germany, also in Italy, we had a very interesting initiatives of companies that went into internet banking to let people trade directly on the stock market. So where does that leave us? Is there a need for capital markets union in Italy? Can they gain something from it, or are they rather on the defensive and wouldn't even be able to use it?
Thank you for your question. I will be brief and synthetic and possibly direct. First, insurance companies are the largest institutional investors in Europe. 10 trillions of investments. The entire market is 100 trillions. Banks are half of this market, 50 billions. And then insurance companies with 10 trillions are the single largest investors. So we support, as European companies, the Capital Market Union and the objectives of the Capital Market Union. We really think that we can do more. The 3 main the three main objectives that we understand positive for us are, in particular, first, removing the barriers, the cross-border barriers for investments. Second, having a more effective investment in infrastructure. Third, high-quality securitization. And fourth is credit to long-term and credit to SMEs. We can do more on each of these chapters, on each of these topics. Regarding your question in Italy, and more general on the investment side of insurance company. Insurance company invest long-term and try to match asset and liabilities. This is first. Actually, in Italy, better than other company, than in other country. In other country, there is a mismatch between asset and liability. I do not. I'm not to go through the presentation. We need long-term investment. This is the main point. And regulation matter. My favorite example is very easy. 15 years ago, regulators in the insurance sector decided that equities was not good for the company. I mean, after the equitable collapse in UK. I'm not going through the details. The effect was that while at the beginning of the century, in the US and in Europe, the level of equity was about 12% each in US and in Europe. Now we have basically 7 percentage points less than that was at the time. Results, 1 trillion less invested in equities. So regulation matters. This is first point. So my feeling is that what we are now doing on capital market union is going in the right direction. Maybe we should be on one hand more aggressive, to be honest, and second, we should not forget equities.
This is a very European view. May I ask you about the Italian point? Italian companies are always going to the bank, and when will they stop this?
Let me say what happened in 2015. According to a survey we made a few months ago, 2 months ago actually, Italian companies invested directly in non-financial firms 10 billions, actually 12 billions. It's a tiny part of our portfolio. Our portfolio is 600 billions, but not quite remarkable for the Italian financial system. The names are very famous: Alitalia, Tecnogym, Illy Cafe, all were financed by Italian insurance company. Through what asset class? Private placement. And this is something that we should think about. I mean, why private placement and not direct bond or direct lending? I mean, there is something about regulation that is at the moment fostering private money rather than money in the public markets. This is something that we should think more. Obviously not now, but I'm sure that in the future we should also think in terms of regulation of capital markets.
Thank you. Maybe come to Mr. Jochen Biedermann from Frankfurt. Germany has always boasted its success in technology, and then it seems a small, cozy financial market, and they seem to remain cozy and among themselves. Is that maybe the vision also from Rome? What can you tell us about the German perspective for whether they want a European basis and whether they can compete in this direction?
Good evening, ladies and gentlemen. I'm going to speak on behalf of Frankfurt Main Finance, which is an association with public and private stakeholders comprising and pooling the interest of Frankfurt as a financial center. Of course, I cannot speak on behalf of all our members, but let me state that my opinion is the Capital Markets Union, the objectives as well as the action plan, which was published end of September, are very broadly shared and seen very positive among the members of our association. I think that's firstly and maybe the most important point. Second thing is, you have said at the beginning, Mr. Chairman, that there will be less banking and more markets. While I fully agree to the second part of your statement, I object the first part of your statement. I think the idea, at least for Germany, is not to have less banking, because banking in Germany works reasonably well. So a few weeks ago, Lord Hill was in Frankfurt. We organized a conference on the Capital Markets Union. He spoke in front of entrepreneurs, small and medium-sized enterprises, and the financial community in Frankfurt. And my impression of listening to what he said was, I think he has a very pragmatic approach of not trying to change what is working, but adding a supplement the things which are not working pretty well. I think the small and medium-sized enterprises attending that meeting, they were asked what needs to be done, and I think they were quite fine with credit financing from banking. This said, of course, choice is a good idea. Having the capital markets, be it bond issues, be it raising equity at the stock exchange, is a good idea, and there's certainly a strong gap which needs to be closed in Germany. We have seen the statistics. I think there's nothing, I think, to argue about this. This will give choice for the investors and also for the companies. A second point which came out of that meeting was there's more need for venture capital. So this is something the entrepreneurs attending that meeting raised. They want to see more seed capital, but also in the following series financing, they feel there's not always the capital available, and capital and investors who understand their business, which is at core, not only capital, but investors who understand their business, then they would like to see. And this leads, I think, to the observation that I think according to latest figures in Germany, I think there's a strong community of startup. Even I think according to latest figures, Germany has a lead now in front of the UK in terms of young and innovative companies. Part of them are active in the financial sectors, the so-called fintech companies, providing alternative funding. So this is something we need to support, and we need to support all these innovative companies by having, I think, reasonable funding options from venture capital up to finally then maybe going to the stock market and raising capital there. This is something where we definitely need to improve in Germany and all over Europe.
Thank you. Thank you, Mr. I try to put some different topic onto the table, that is the relation between the center and periphery. How centralized, how decentralized should the Capital Markets Union be? We have two interesting examples. We had President Belka from the Bank of Poland, who said, look, there will be small Polish companies that would like to emit bonds, and you shouldn't forget them, and it's difficult that they will be seen from London. And then we had Mark Garvin, who said, well, let's have huge pension funds that centralize, that give us, well, he didn't say a centralized view, but there are big advantages of being big. May I quote it like this? So may I come back to Paris to say, what is the way that we can, in which we can balance, reinvent relation between center and decentralized structures without just defending old things, the old structures?
It's a key question. It's coming back to this concept of prox union, how we can deal in the same time on this convergence diversity. We are diverse and we have to converge at the same time. Two examples. We have to overall industrialize our project, our instrument, our approach. Industrialize means that we have to share best practices, covenants, legal text around those instruments. And an example is Euro private placement, for instance. We are pushing very much Euro private placement because we just realized that a certain number of French mid-caps were going to get some euros in the US. And we thought it was strange and maybe they could get euros in Europe, in Eurozone. Then we had to install. Then after 2 years of work, pure bottom-up approach, no new regulation, no regulation, we've been able to build up some covenants, some texts to define the proper balance between the investors and the corporate and the arrangeur. And this approach we discussed with the City of London, and they are interested to adapt. It doesn't mean that it will be a French approach. It will be a process that could be adapted to other countries. And that is a very interesting example of how we can articulate a kind of customization process, mass customization, meaning we have in mind to create critical mass. In the same time, we try to customize to the reality of the ground. And today, we issued last year something like 6 billion euros, but out of the 6 billion, 2 billions were issued from non-French corporate. That was very interesting. Another example, which is quite interesting, is crowdfunding. I organized a seminar on crowdfunding, and intuitively we could say crowdfunding is totally local. Then, and that's the position of the Commission, saying, okay, we don't care about crowdfunding. Each country will deal with crowdfunding. But when you get those crowdfunders from different countries, England, Netherlands, Belgium, France, and so on, you realize that what they have to do, those guys, is to win money with deals that in the real world for big corporations is very costly. Then it means that they have very small tickets, they have to make the same deals, very costly. The only way is to highly standardize, and not just at the national level, all over Europe, because they need the critical mass and the leverage. Then those guys are asking for common regulation. And that was surprising. Okay, then 2 examples.
Thank you. So, Mr. Foccarelli, Italy has been long time defending its traditions, and then the stock exchange was sold to London. So what's the perspective now? Just cling to a few last bits of tradition, or just take the insurance view, have big European-sized insurances and don't care about Italian local traditions? Where do you want to position yourself?
Let me say that I'm very sympathetic with the position expressed by Governor Belka in terms of it's quite clear in finance that there is a non-bias. In each country, in each sector, there is some kind of own bias for investors. I mean, you invest more in where you know more. So we have to keep in mind that there is own bias. So it's very important to have institutions which are able to channel funds in a given country. for example, I already gave this example of the private placement, 10 billion investment of Italian insurance company in Italian companies through the private placement, which sound very strange, to be honest, in this discussion on capital market. But at the end of the story was an adaptation of what the regulation at the time didn't allow directly, because it was not possible to direct lend on the company and so on and so forth. So local operators obviously are much more willing to adapt their operational activity to the local economy. So this is important. On the other hand, let me say that if we want a capital market union, we should have a more larger focus on this. And this compromise, the success of the capital market union is exactly in this. The ability to have a single market, a single capital market, working for different kind of non-financial enterprises. It's a challenge, it's an enormous challenge. I'm not sure that the success will be in a number of years, less than 10 years or 15 years, but definitely it's something that is worth to try.
Thank you. Mr. Biedermann, may I launch you another provocation? So Germany is a federal state and Europe wants to be federal. So Germany had the federal system of stock exchanges and most of them have died, and there's Frankfurt that remained. So we have a few specialists around. So what will be the role, or what would Germany, Frankfurt see itself, where would they see themselves in a few years' time? Will they die down like a stock exchange of Munich in front of the stock exchange of Frankfurt within Germany? Will we have Frankfurt losing against London?
I think it's not a matter of Munich or Frankfurt or London. I think the regional exchanges which exist in Germany for historic reasons, coming from the federal structure, I think they have their purpose in serving local companies, in particular small and medium-sized companies. So I think they exist for good reason, but I think that's not maybe the topic for our discussion. If I look at the German situation, of course, European Union regulating and encouraging capital markets union and cross-border investment is certainly one way which is very helpful. But then, in addition, we have several issues in Germany. I think it starts with tax. So I think providing tax incentives, maybe for venture capital or maybe for investing in small and medium-sized enterprises. This is something, at least for venture capital, which currently seems to be in the progress on the German government side. So this is something which can be handled in Germany. But there are other issues. We have the risk awareness among German investors. They prefer to have their money on the bank account, currently at negative real interest, so means they're losing money. But I think to change their mindset is probably, I think, a challenge over decades. It's my impression. Then we have in Germany, as in many other European countries, a home bias. So the investors prefer to invest in their own country, in their own stocks. They think they know better. So that's maybe something with more transparency, more information, better information on a European scale. There could be done an improvement, but also here I think it's more a long-term, thing to do. And last but not least, I think I could add to that list, but last but not least, what I want to mention is, I think, small and medium-sized enterprise owners shying away from using the stock market. They fear in many cases pre- and post-IPO requirements, transparency, or all the red tape which is, I think, involved into this. In some extent, they're looking into bonds, raising corporate bonds, which is so-so, some sort of successful, but there also were cases where small and medium-sized enterprise went bankruptcy and investor lose money. So this is, for instance, something the exchange in Frankfurt is still promoting, but it's probably also not the way out. So the exchange can certainly do and encourage, I think, using the capital market, but my take is it's a long way to go, at least for Germany.
So let's come to Nicky Edwards from London. So London wants to be bigger, but it's not in the euro, and it still discusses its future.
I will resist the chairman's invitation to provoke an international incident, and I wouldn't want you to think that the member firms of the TheCityUK are wrapped in the Union Jack. The banks, asset managers and insurers that are UK-based come from all over the world, and one of the reasons that they choose to locate in the city, which is Europe's financial centre, is precisely because it gives them access to the single market of 500 million people. Capital Markets Union will only work if it reaches across all 28 member states and all 500 million people, and can demonstrate that without having to replicate every part of the financial infrastructure in each member state, they can access what all the financial centres offer. It's not a zero-sum game between London, Paris, Frankfurt or anywhere else. The more the single market for capital is enabled, the better it is for all those centres and for all the people they serve. And you touched on a little local difficulty that Britain is having at the moment. One of the reasons that we in the city have worked so hard to be constructive partners on the Capital Market Union project is we need to be able to demonstrate to the people who will vote in a referendum what it is that they get in the practical consequences for their own lives, their own SMEs, their own businesses, out of having access to that single market. We are very keen, while not telling anyone how they should vote in a referendum, to demonstrate the importance that our member firms place on being part of that single market and being part of those 28 member states.
Thank you. Mr. Llewellyn.
Thank you, Chairman. Just a couple of points. I want to emphasize I'm independent. I don't represent anybody.
Lucky.
And I don't come from the United Kingdom either. I come from New Zealand, which is so small and so far away that I don't suffer from home bias. That doesn't mean that I'm right. It just means that I don't suffer from home bias. But just some quick observations. I think we must be very careful not to confuse two issues, which is where an activity might be located and the laws governing financial flows. They are really two quite separate things. And really, if we really felt that we were talking about a properly united Europe, we wouldn't be having the discussion about caring about where it's located. The United States does not care that the financial services industry is largely located in New York. Just isn't an issue. And you wouldn't have a governor from Arkansas saying, I think we should have part of it located down here. I don't think he would do that. At the same time as saying that, if you do look at the UK, you find that in my judgment, the loss of the building societies, which had local knowledge, when they wound themselves progressively into banks, and now there are only 4 and they're centered in London, 4 big ones, was a big loss because you lost a lot of local knowledge. And there in the United States, they're much better placed, although the situation is changing, because they have local banks with local knowledge. So I think those two things have to be separated. And lastly, Mr. Chairman, I can't resist provoking Mr. Biedermann, who tells us that the German banks are doing, by and large, a pretty good job. Because certainly from where I sit, the German banks are the least competent and the most lazy of all the banks in Europe. They didn't do their due diligence. They thought it would be a nice, easy way to make money was to lend it to Greece. Any competent risk analyst would have said that money is going to be a problem. And they had to be bailed out by their own government indirectly by bailing Greece out. I don't think that's a good performance, frankly.
So thank you. I think this is going to take us too far. Maybe we're not going to discuss the pros and cons of German banking. Please let me try and have a final round, a more journalistic type, or like publicity type. So I think all big topics are simple and can be sold to the public. I remember the common market was a real popular topic, And also the Big Bang was a popular topic. So what is the headline that you would give to your advertisement when you were asked to give it a simple headline, like get venture capital to young people who want to start companies, or going to the stock exchange is a step forward in corporate culture, and you get better candidates among your employees. What maybe ask start from Mr. Biedermann. What is your headline for the advertisement for the Common Markets Union?
I feel enticed to answer to the question before, but yeah, let's focus on your question and not trying to defend German banks, which I said are doing well for financing small and medium-sized enterprises, which not necessarily contradict with other observations. So for me, in my opinion, it's very important to stay innovative in the European Union. I think young companies and their financing, this should be our concern. We are seeing a lot of change, so technology development is developing very, very fast. We see things like Industry 4.0, which is changing the way we are doing manufacturing overall. And so if we want to stay competitive in the European Union, so we should help those companies wherever they are in the European Union to grow. So the headline is make sure that European Union grows by innovation.
Directly to the headline, improve access to financing for all business around Europe.
Grazie.
And that access to finance for all of Europe's businesses will be quicker, cheaper, and come from more diverse sources.
It will be fuel for prosperity, being ambitious.
I've said my say, thank you very much.
Well, anyway, fuel for
Prosperity, because we understood that growth was better than prosperity. No, prosperity was better than growth.
Resist the temptation of going back to 95, but not 1995, but 1795. Alexander Hamilton, in the middle of the American Revolution, he called this, an experiment like this, he called it the financial revolution. And he was a very cultivated man. And he was linking it back to the experience of the foundation of banking in Italy, and then to the Dutch Revolution, and then after that to the English, who, by the way, brought a Dutchman to become an English king in order to stimulate a financial revolution also in England. So saying that you need a financial, he added a financial federalist revolution to have long-lasting and sustainable growth and jobs.
Thank you, and that was this for this evening. The meeting goes on tomorrow at 9 o'clock, as I understand. Thank you.